Alright, hello everyone, welcome back to the channel. This is Emil, and today's video we're going to be looking at Footlocker stock and whether I think it's a buy or not. So I'll just run through what we're going to look at. We're going to look at the growth potential for Footlocker, the risk, have a look at their balance sheet, their return on invested capital, and their dividend. And we'll just go through their numbers as well, right here. So hopefully you can see everything on the screen here. So cool, let's go back to the presentation. So first, I always like to categorize what kind of stock I'm investing in. So for Footlocker, it's kind of a mix between a few different categories, the mix being value, dividend, and maybe a turnaround. So yeah, as you can see, Footlocker's stock price has dropped quite significantly, from about $70 down to $23. Which has really made it quite a value play, perhaps, and a really high dividend there, of almost 7%. So that's kind of the two things I'm looking at with Footlocker. I'm looking at their dividend because they've increased the dividend by 10% a year for the last 9 years, I think. We'll get to that later anyway. And they have a low PE ratio. So why has the stock dropped so much, and why is it so undervalued at the moment? It's because of the coronavirus, just like everything else at the moment. Yeah, they've had to shut all their stores. No one's buying shoes right now. But in the future, I believe Footlocker could do okay. Yeah, I don't usually like to invest in retail companies. However, because Footlocker sells shoes, most of its sales are shoes, obviously. Personally, I've never bought shoes online. And I think most people like to actually physically try on a pair of shoes before they buy them, just to make sure they're the right size and right fit. Kind of matters more than with just clothing. So that's why I'm not as worried and not too worried about investing in Footlocker. But it has to be said that Footlocker is not a fast grower. It's a very old company at this stage. So the growth is limited, and they're kind of relying on foot traffic in malls and shopping centres. So yeah, we'll just have a quick look at their potential growth points, see if they can grow at all. And if they can't grow, then we're just relying on their dividends and share buybacks to increase the value of the stock over time. So Footlocker are trying to expand into Asia. They've expanded into Europe and Australia, but now they're trying to look into the Asian market. So they've just opened in Singapore, Malaysia, and Hong Kong. And Asians do like brands, so they like buying. They'll enjoy buying like Jordans and the more expensive, nice shoes that Footlocker has to offer. Yeah, and 70% of Footlocker sales are Nike. So if you're investing in Footlocker, you're really investing in Nike. You really have to believe that Nike's going to do well in the next few years. Yeah, you might ask, oh, why wouldn't I just invest in Nike then? Well, if you look at it, Nike's market cap and its PE ratio, it's nowhere near giving us the type of value that Footlocker is. Yeah, people definitely believe in Nike, and has a PE ratio of like 30 and market cap in the hundreds of billions, whereas Footlocker is $7 billion market cap. So it's a bit more of a value. Like Nike, it's a great company. I'd love to invest in it personally, but just a really high price to earnings ratio at the moment. So not interested at the moment because of that. So let's just quickly go over some ways Footlocker earnings can grow and therefore the stock can grow. So yeah, the price of athletic shoes is always going up. Anytime you go to buy a new pair of Nikes, the newest ones are always €10 more expensive each time they bring out new ones. People are becoming more health conscious, so they want to run more. There's more people in the world as time goes on, so there's more feet. And Footlocker like trying to bring on like the majority of their sales, especially the majority of Footlocker's high margin sales come from men my age, so between 17 and 27, getting like fashion statement shoes. So the fashion statement Jordans or those I don't know. I'm not really interested in the fancy runners and the fancy trainers. But yeah, they're majority men anyway. So they're trying to focus more on women and getting them interested in those Nike shoes as well. So also Footlocker has closed a lot of stores. They closed 60 stores in 2018, or sorry, 2019. Um, and they opened 30. So they're just closing stores in malls that aren't getting enough traffic and opening in new places where the people are, because shopping malls, shopping centres, people are going to them less and less as time goes on, as people go online. So anyone who's just passing by Foot Locker and goes in and buys shoes, that's reducing in those kind of places. And Foot Locker are looking at increasing their direct to consumer sales. So you can go onto Foot Locker and you can go onto footlocker.com. You can order a pair of shoes and pick them up in a Foot Locker nearest to you. Okay, so let's go over the risks with Foot Locker. So yeah, Foot Locker do have the growth potential of the online. At least they're aware of the change of consumer behavior. Although personally, if I was going to buy a new pair of Nike shoes, am I going to go to Nike.com or Footlocker.com? That's a general question. So I'd like to hear your opinions. Would you go to Nike.com or Footlocker.com? I suppose maybe if you want a range of shoes from different brands, you go to Foot Locker. But if you're sure about Nike shoes, you probably just go to Nike. So that's a risk in my opinion. Yeah, Foot Locker has always be on top of trends, and they heavily rely on Nike and all the brands that they sell to continue giving them the good terms that they have. So Nike allows them to return the excess items that didn't sell. They advertise together, like Nike and Foot Locker will have joint advertising, and Nike or the other companies will give them like the newest shoes and give them at competitive prices, so Foot Locker can actually make money. And yeah, just the shopping centre traffic to continue to decline. So yeah, Foot Locker is a pretty good balance sheet. I tried to look at as much as I could online, but I believe they lease most of their stores, although they have net property and plant at the moment of 5 billion, which has just gone up quite recently from like 3 billion. It's gone up to 5 billion. So I'm guessing that is new stores that they bought rather than leased. But if they have bought stores in the far past, in accounting, you just on the balance sheet you put on however much you bought it for, and you don't take into account how much it's worth now. If you bought some prime retail location 20 years ago, it's going to be worth a lot more now. So I'm just looking at the balance sheet and just thinking whether their net property and plant is worth a whole lot more than it says so on the balance sheet, which could mean it's an even better investment because they own more assets. Their current market cap is 2.3 billion and the stockholder equity is 2.5 billion. So the stockholder equity is kind of like how much they're worth on paper, sort of. So yeah, it's nice to see it. It's kind of a value play in the sense that the market cap is lower than the stockholder equity. But the stockholder equity, like, you can kind of fiddle around with the numbers, so don't think, oh, it's selling for less than what it's actually worth without the business. It's not exactly what's going on there. Foot Locker have invested a lot of money into opening new stores, and their return on invested capital on these capital expenditures has been 12.5%, which is pretty good. They have these new power stores, which is like the ones I showed you at the start, these ones. So they look pretty cool. You can, like, some of them have a basketball court on the roof, and it's kind of trying to not just be a shop, kind of like be a place where people have more of an experience rather than just, buying a pair of shoes. Foot Locker have also taken some minority stakes in smaller retailers, just to kind of diversify it, help them out and learn from them at the same time. So their revenue has been increasing steadily, but their profits have been decreased. So this looks bad to most investors on the surface. Profits going down. So I think that's another reason why it might be Footlocker might be going for a little bit less than it should be, because the profits have been decreasing. But when you look at the capital expenditures that they've been implementing over the last few years, you realize where the profits are going, and it's being reinvested into the business. So I'm not worried about that. As long as revenue's increasing and I can see where the profits are going, and the return on invested capital is 12.5%, which is nice, then I'm not worried about that. Okay, so yeah, just quickly going over the numbers. Market cap's 2 billion, their revenue is 8 billion, so really undervalued in that sense. Price to sales 0.3. So usually you have a price to sales of about 1. Most companies, it is the normal amount. I also like this fact here. So there's 22% of the shares are held by insiders. So this could be the CEO, and it could be major people in the business, and they believe it in enough to actually own the stock. So that's always really good to see. And I actually like seeing when it's not a high percentage of institutions, because if there's a huge amount of institutions, it's not really going to be a fast grower in that case. Okay, so let's just have a quick look at their balance sheet. As you can see, for the last 4 years, their cash balance has hovered around the $1 billion mark, which is enough to cover their short-term liabilities for this year anyway. And they have pretty much no long-term debt. It's in the hundreds of millions, so let's just count it to 0. Yeah, so as I said on the last slide, they have net property and plant of like 5 billion, but I'm not sure whether they own many of their old retail stores, and if in that case this could be worth a lot more, which would be good for us. So this is their earnings per share growth projections. This is the revenue growth of the last few years. 2017, 7.8 billion. 2018, again 7.8. They're growing really, really slowly. Okay, so as you can see, their revenue is increasing, but pretty much in the low single digits percentage-wise, so not much growth. Next year, they're obviously, because of the coronavirus situation, their sales are going to take a big hit. So the average estimate is 6% down from 2020. Well, Footlocker, their year end is 2020, so this should be 2021 here. They end their year in January 1st, 2020, because all their sales come in Christmas, so they're too busy to do their accounts until January. And then, yeah, so sales are projected to come back to normal range by 2021. So their next 5 years revenue growth is estimated to be 7% a year. So that's pretty good. Cumulatively, Jesus, that's hard to say. The last 5 years have only been 6%. So yeah, a little bit of growth there. But where does most of the growth come from? So most of the growth is going to come from their dividend. So their dividend has, for the last 9 years, has increased by 10% minimum. So that's a really good growth rate for such a slow growing company. So Footlocker are kind of trying to give back to they're not investing too much in the business. They're kind of expanding a little bit into into Asia. But they want to reward their shareholders by doing buybacks and by continuing to increase this solid dividend. But who knows what happens to this dividend in the short term. So as you can see, Footlocker's dividend, the payout ratio is only around 30%, so this is very safe. Even if Footlocker takes a huge hit, 60% hit on earnings, they'll still be able to pay out the dividend. And they have 9 years of consecutive dividend growth, which is pretty good. Yeah, so they've been taking a lot of shares off the market, so that means the shares that we're buying today are worth more, are more scarce than they were a couple of years ago, which is nice. Which means when this this can kind of start to bounce back a little bit faster. So I think this is a great company to invest if you want a dividend company. I think it's safe for the next 5 to 10 years, and we'll reassess after that whether people are really moving to online e-commerce. But I'm happy to collect a 7% dividend yield for the next 5 to 10 years with a compounded 10% dividend growth. Also, maybe 2% growth in sales, which will also raise the stock price. And even if we can get anywhere near where it was before, we're looking at a pretty good return. So yeah, I've also opened an initial position in Footlocker, and I'll continue adding to it if it drops. If it continues increasing, maybe I'll add a little bit more. I'm just going to keep it a very small portion of my portfolio. I'm not going to make it a huge part of my portfolio, but it is an interesting stock. So I'm just telling you what I'm doing with my money. You do whatever you think is right for you. So yeah, that's all I have to say for this video. If you enjoyed the video, I'd hugely appreciate it if you could give me a like. I hope to see you again. I have a few cool, interesting videos coming up. Square Stock, Facebook, and some more really interesting ones coming up. So make sure you subscribe so you can catch them all. Okay, thanks so much for watching. Catch you in the next one. Cheers.